Are small capitalization stocks already starting to benefit from lower inflation? And is there still time to make money? Small cap stocks have severely underperformed the major indices so far this year, as I discussed in my videos from last week. Links in the pinned comments below. Just look at this comparison between the ETFs representing the NASDAQ 100, the S&P 500, and the Russell 2000 or small caps. Here's the problem. The NASDAQ 100 is up 17% year to date. The S&P 500 is up 14.5% year to date, while the Russell 2000 or small caps are only up 1.1% year to date. But this is a small improvement from where they were last week when they were down 0.2% year to date. Has this recent rally in small caps just begun? And is it too late to invest in this underperforming segment of the market? Should you consider adding small caps or keeping your current small cap holdings if you have them? This is extremely important, so keep watching to find out. Or look, are small caps down for a good reason and you should avoid them? In my two videos from last week, I went over the definition of small caps. Currently, small caps are defined as publicly traded companies with a market capitalization of between $250 million and $2 billion. This segment makes up about 32% of the overall stock market of U.S. traded companies. It's not rocket science why small caps have severely underperformed so far this year. The Fed has raised interest rates at an incredible rate, causing small caps and some higher risk larger cap companies to be ignored so far this year. But it's starting to look like small caps are benefiting from the perception that the Fed will start to lower interest rates later this year. When the Fed starts lowering interest rates, the cost of capital, as you can see here, or the cost to borrow money will come down. But as importantly, the risk-free rate used to calculate the value of a company will also come down. This has the effect of increasing the calculated value of all companies because the risk-free rate is in the denominator of the intrinsic value equation, as you can see here. By the way, this is a great paper by the Harvard Business School to give you a better understanding of how Wall Street calculates and thinks about the value of companies, and I'll put a link in the pinned comments below. I won't get into the details of treating small cap stocks as value plays here, but watch my video titled "Should Warren Buy Tesla? A Question of Value?" to find out why trying to buy high-growth stocks at a value is a total fallacy. Link in the pinned comments below. So are small caps starting to benefit from the prospect that the Fed will lower rates later this year? Before we talk about that, it's important to understand that I would not recommend including a small cap ETF in your portfolio over the long term. In this video, we're focusing on a unique situation where it's possible that small cap stocks could perform better over the next 6 to 24 months, call it. So this is a trading idea, not an investing idea. And be forewarned, there's no guarantee it'll work out. But if you decide to try and make some sort of short-term profit on small caps, I would recommend taking a small portion of your portfolio, let's call it 5 to 10% or less, and start to dollar cost average into small caps over the next several months. In other words, don't dump the entire 5 or 10% in now, but maybe split it up into 5 to 10 parts and invest it over the next 5 to 10 months. Another way to take advantage of this opportunity is you can invest in several individual small cap companies, but I've got to tell you, that'll take a lot of work to analyze and select them. For most people, it would make more sense to invest in the ETF IWM to get small cap exposure, or select one of the ARK Invest funds that focuses on innovative technologies, or a little of both. In both of these cases, they'll benefit if and when the Fed starts lowering rates. But in the case of ARK Invest, it's a little bit of a different story. These are innovation stocks, so yeah, they'll benefit as the Fed lowers rates, but some of these may not be coming into their prime based on the underlying technologies and the market adoption. So it's a little bit of a different twist on things. As investors pour into the beaten up, smaller and innovative companies, these companies could move higher in a dramatic way. Are small caps just starting to benefit from the anticipation that the Fed will lower interest rates later this year? It kind of seems that way, but the markets and the economy are not predictable. So proceed with caution and always keep 40% or more of your portfolio invested in U.S. government treasuries, as I discuss in the videos linked at the end of this video. But as I cautioned earlier, this is a short-term strategy for potentially increasing your portfolio returns, and it's not a long-term buy and hold strategy. As a result, I wouldn't recommend this for most investors. Most investors will be well served by holding on to large cap stocks and ETFs combined with safe government treasuries over the long term. Do you think small caps are finally starting to move higher? Please let me know what you think in the comments below. With all that being said, let's take a look at the current health of the stock, bond, gold, and crypto markets. So if we take a look at the equity markets over the past week, kind of an interesting picture here. I mean, look at this. ARK Invest at the top. That's what you want to see, followed by small caps at the top. You can see both of these shot higher at the end of the day on Friday when the NASDAQ 100, the S&P 500, both fell off. Now the Dow tried to also rally at the end of the day, which is kind of interesting, but still ended the week lower. So this looks good to me. This looks like the start of maybe something good. Isn't there a song like that? And if we look back over the past month, you can see this looks somewhat healthy and somewhat not healthy. We have the NASDAQ up here at the top, although it's been kind of waning lately. We've followed by the S&P with the Dow smack in the middle, and then ARK Invest and small caps down here at the bottom. And if we look at year to date, you can see that the NASDAQ's up at the top, S&P second, Dow third, and then small caps, and then ARK Invest really lagging behind here. And over the past year, a very similar picture. So this looks like somewhat healthy, but the health is in the larger cap NASDAQ 100 stocks and the S&P 500 large cap stocks. And what about the current bottom dynamics? Well, as you can see here, this is really interesting. You can see that the confidence level has just dropped, fallen through the floor here. It's not only negative, but it's pointing straight down just about. And what's interesting is that the bottom confirmation level was moving higher here. This is a market that doesn't know where it wants to go. There's no confidence. I don't know quite what to make of this. I would tend to say it's likely this is going to falter going into next week. But on the other hand, when we look at risk versus opportunity, look at this. This is fabulous. You've got risk acceleration, this yellow line, not only pointing down, but it's at an extremely low level down here, just above 20. At the same time, risk, which is very much a lagging indicator, you can see it's been falling, and it continues to fall, and it's well below 70. In fact, it looks like it's below 65. That's not bad, and I like the fact that it's moving lower. On the flip side of it, if we look at opportunity acceleration, this solid purple line, you can see that it's been moving higher since way back here. In fact, it's been moving higher at an even quicker pace more recently, and you can see it shooting up. It's above 70. This is great. And then if you look at the equity opportunity level, this blue line, again, like risk, this is a very laggy indicator, but you can see since back here, it's been steadily creeping higher and continues to do so. So this is a real contrast to the previous slide because this looks great. This looks like we're going higher next week. So, low confidence, mixed signals. I don't know what to expect. And what about equity versus safety? Well, this looks interesting. Let's go right into the overlays. So if we take a look at the overlays, NASDAQ 100 straight line right across the top in first place. This is fabulous. And then cash has moved down to sixth place and is staying there. I like that. But then you can also see small caps are all the way in 10th place. Now, if they continue to rally, this will obviously change, but right now it's not a good look. And then if we overlay the S&P 500 and the Dow, you can see that both of them moved up. The S&P moved from fourth place up to second place, which displaced ultra-long U.S. Treasury bonds and 20-year bonds and pushed them down here. And the Dow also moved up. And what about safe haven assets? Well, you can see that EDV and TLT, as I mentioned, got pushed down one notch by the S&P 500. Cash stayed put. Intermediate treasuries moved down. I don't think it moved down so much as it got pushed out of the way by the Dow and the S&P 500. And then short duration treasuries, SHV, also got moved down one notch. Now, did gold move up, or did IWM push it out of the way and force it up? Not quite sure there. But I think given what IWM has started to do, if that continues, it will definitely move up here in the rankings. And how does all of this show up in the buying and selling pressure? Well, you can kind of see what's going on here. The Dow has been kind of trying to rally, but we've had a lot of selling pressure in a couple of instances. The buying pressure was above here, but it's since collapsed. This does not look good going into next week. The S&P 500, even though it's pushed up in the rankings, you can see that the price has been faltering and the selling pressure is moving higher. So this doesn't look good going into next week. What about the NASDAQ 100? Just like the S&P 500, same picture. Faltering price action, selling pressure moving higher, and above the buying pressure, this solid gray line. Now, small caps, a different picture, right? Terrible. It was just declining here. Now it's been trying to rally recently, but you can see that the buying pressure not only is above the selling pressure, but it's shooting higher. So I'm hopeful that small caps will perform well next week. And if we look at ARK Innovation, remember I said this is a different animal. So the stocks held in ARK Innovations Fund are a combination of large cap and smaller companies. So you got kind of a mix here. But the play here is that Cathie Wood is betting on innovative technologies to come into the mainstream and be adopted and drive the price of her fund higher. So this is not a pure small cap play. And so it's not acting like small caps either. You can see that the selling pressure, this solid orange line, is moving higher, and the price is basically overall kind of declining here. So not looking good for ARK Innovation, just like it's not looking good for the NASDAQ, the Dow, and the S&P going into next week. And what about sector rankings? Well, sector rankings, actually, these are a longer view. They're kind of a look into the rearview mirror. But even with that, this week, they look pretty good. You've got utilities up here in first place. Now, normally that's a safe haven asset, but you've heard me talk about this in my previous videos, that in this case, utilities are up here at the top because there's a very high demand for electricity production and energy production to support artificial intelligence. And you can see the same thing with clean energy here. So this is looking very healthy. You've got technology, clean energy, the NASDAQ 100, XLK, which is technology, and then you've got emerging markets up here. And you've got consumer discretionary moving up, and you've got cash staying put. So this is starting to look pretty healthy. I'd like cash to move down, and in fact, I expect it to do that going forward. Let's look at sector rank acceleration, because these give you a more, I wouldn't call it real time, but it certainly has less delay in it when you look at this. And to understand this, let's take a look at the overlays. So what looks good here? Well, a lot. As you can see, green arrows all over the place. So, clean energy moved down. I made that kind of a yellowish green arrow, but I like the fact that it's still up here in the top 4. You've got these two technologies, semiconductors and XLK, both moving up. And then you've got the NASDAQ 100. Yeah, it moved down a notch, but it's still up here in the top 4. So this looks great. Now, under different conditions, I would say 20-year treasuries moving up is a red line, not a green line. But in this case, I believe long bonds are moving higher because of the anticipation that the Fed's going to lower rates. This will be very good for equities going forward. And of course, look at cash. Wow, that has really plummeted here when we look at sector rank acceleration. Consumer discretionary stayed put. We've got emerging companies, small caps moving up. No surprise there. They've been rallying lately. And then we've got utilities moving up. But again, I put a green arrow on this because they're doing this in response to the demand for energy to support artificial intelligence, compute power. And then we've got consumer staples moving up. I mean, again, these are equities. I'd prefer that they stay down here somewhere and let consumer discretionary move higher, but I'll take it. They're moving up. They're equities. They're fine. And then emerging markets also moved up, and gold moved down. This looks great. So what doesn't look so good? Well, I don't like the fact that the Dow moved from up here all the way down here, and I don't like the fact that ARK Innovation moved down a notch. But this really isn't bad. There's a lot of goodness in this table right here and very little badness. So this looks great. And what about Treasuries? Well, kind of a rough ride here this last week. You can see they tried to rally, and then at the end of the day on Tuesday or beginning of the day on Wednesday, they really got nailed, plummeted, fell again on Friday, and finished the week lower. This does not look healthy going into next week. What about over the past month? Well, over the past month, I like the fact that the longest duration Treasuries finished on top, 20 years next, and the shorter you go, the further down the line. This looks good, but I don't like the fact that they're all rolling off. So hopefully this will turn around. And then if we look at year to date, you can see exactly what happened here. We're backing off from where we were up here. And then over the past year, again, this looks not healthy, but I like the fact that these have been moving up. My hope is that the CPI, the PCE, and the PPI will all come down, and these will turn around and start to move higher. And how does this show up in the buying and selling pressure? Well, for short duration Treasuries, price moving higher, buying pressure above the selling pressure and moving higher. This looks great. Intermediate Treasuries, buying pressure, the solid gray line above the selling pressure. It's not moving higher, though it's declining, and the price has been faltering lately. If we look at 7 to 10 year Treasuries, same picture, faltering price, buying pressure above the selling pressure, but you can see it's falling. And then long duration 20-year bonds, you can see that the buying pressure moved quite a bit higher here. But if you look at this, it's trending lower as the price has been moving higher and is now flat. So this doesn't look good going into next week. I think these might pull back more before they turn around and start to go higher. And what about that inverted yield curve? Well, if we take a look at that, we're a little less inverted than we were last week. But the reason we're less inverted is because interest rates have gone up at the long end. That's not what I want to see. And we're not going to see the rates go down at the short end until the Fed lowers them, because that's what they control. And what about the Fed rate monitoring tool? Well, when the Fed meets in just a little over a month from now, right now the markets are saying there's almost a 90% chance they'll leave rates exactly where they are. Now, if we go out to September, you can see that drops way off. There's quite a bit less than a 50% chance that rates will be where they are now. And there's a pretty good chance that rates will be lowered by at least 0.25%. And then obviously, if you get out to November, that keeps stacking to the low end here. So, by December, hopefully we'll see more than 0.25% reduction in the current interest rates. And what about gold? Well, if you take a look at gold, it's going nowhere to down. And you can see that here. And you can see that the selling pressure has been increasing lately as the price has been wobbling and declining. So really nothing here to see. What about Bitcoin? Well, Bitcoin has really been struggling. We had a big rally. If you've been following this at all, it was a huge rally over the past several months. But you can see that the price has been declining. And as the price has been declining, the selling pressure has been increasing and it is pointing higher. So doesn't look good for Bitcoin so far right now. As you can see from the price movements and metrics in the buying and selling pressure charts for equities, the markets, which were avoiding small cap and innovation companies in favor of larger cap AI exposed companies, have, at least in the case of small caps, started to rally. Why? Because investors are trying to position themselves for lower inflation and lower rates from the Fed. Again, investing in small caps now is a short-term trading strategy and not a long-term investment thesis. So it's not for everyone. And if you decide to give small caps or innovation a try, dollar cost average into these investments over the next several months. Don't do it all at once. If there's one thing to take away from my market reviews over the past several weeks, it's that the equity and bond markets, which were moving higher, are starting to falter a little bit, but no one has a crystal ball. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.